Welcome, ladies and gentlemen, from me, Guy Monson, Chief Investment Officer of Sarasin Partners, to our 7th weekly strategy update. We begin these sessions by looking at the progress of the virus around the world, taking the number of days since 200 new cases were established in a single week. The cluster around the middle of the screen, where the red arrow is, shows the rolling over of many of the European infection rates, with particularly better data out of Spain, Germany and France. The UK now in dark red, the highest of those lines, but also clearly rolling over, as the Prime Minister indicated last night. On the left-hand side, you can see the sharp rise up in Singapore, that beginning to roll over. That was that secondary infection in some of the cramped worker dormitories. Extremely good numbers out of South Korea. In general, this is allowing Europe to ease some of the lockdowns, with Italy beginning after 2-month lockdown to begin some relief on Monday, France on May the 11th, the UK at least issuing a plan next week. The WHO was very clear in the comment below and is urging countries to find, isolate, test and treat and trace every contact. So that will be the emphasis that we will see in policy over the coming weeks. The second piece of broadly good news is that the range of vaccines and therapies around the world is extending all the time. Now, this has been prepared by our pharmaceutical team. None of the solutions here are silver bullets. They're all incremental. Highlighted in red are names of companies that we hold in among our funds at Sarasin, who are potential beneficiaries, and the titles listed in blue are the most promising developments. Number 3, the mRNA, the new, fast-to-make but untested vaccine strategy, probably the most exciting and the most timely, looking to therapies that might mitigate the impact of the virus. Antivirals, there on the right, remdesivir, this drug that first showed rather poor tests, this week showed rather better tests, and potential, particularly for neutralizing antibodies, smoothers that spike the protein of the virus. So again, none silver bullets, but the international cooperation, which some scientists say reminds them of the Manhattan Project in its scale, scope and drive, is having an impact. On the less good side, I'm afraid this week saw some grisly economic numbers. And we've updated our own forecasts, and I'm afraid in almost all cases they're worse than we anticipated a week ago. And to use the phrase I used last week, jaw-droppingly awful for the Eurozone and UK, almost 9% forecast drop in GDP this year, 8.5% Japan, 5% the US, and 5.8% the world overall. What does this look like in historic context? Well, it's almost 3 times the economic drawdown that we saw in 2008-9. It's not just our forecasts that are reflecting this. This is the latest from the Congressional Budget Office, which report to Congress on their own estimates of US growth. In the red box, first red box at the top of the block, real GDP falling 11.8% in Q2. That's equivalent to a 40% annualized rate. Extraordinary. The unemployment rate going from 3 to 14 to 16%, but rolling over by year end. Interestingly, also, they made projections of where interest rates and the 10-year bond would go in those last 2 lines. Interest rates they see flat at 0 or 0.1 out really to 2021 and beyond. And for the first time, they see bond markets flat at around, bond yields flat at around 60 to 70 points, as the Federal Reserve acts to suppress any backup in yields. Federal budget expected to be a staggering 3.7 trillion. Federal debt probably, as we'll see in many parts of the world, peaking at over 100% of GDP. So what are the broad assumptions you should be putting into your thinking? Well, one, we're assuming that the lockdown measures are gradually eased, Q2 being the worst point in activity, but it rebounding to round about 95% of total economic activity restored by year end. That's consistent with global growth falling to about minus 5.8% for the year, and pre-corona level won't, I'm afraid, be achieved to somewhere around 2022 or beyond. Even with the Federal Reserve's big bazooka, these huge moves by central banks, and a giant fiscal offset, which could be up to 12% of GDP in the US. Now, I'm afraid these numbers will start to trickle through, and I think what spooked markets in the last few days of this week was some of the extreme drawdowns. On the right, I've got the quarterly data as it comes in. The US down 1.2, the virus had hardly struck in Q1. Euro area down 3.8, Spain down 5.2, France down 5.8. Remember, this is just Q1. Now, we don't get the UK data till the second week of May, so I'll fill this chart in subsequent talks. So what does this mean for markets? Well, it's been an extraordinary month. One of the strongest months for equities in 20 years. The S&P 500 up 17% on the month, NASDAQ a extraordinary 20% on the month, Europe up 9%, and the UK, the laggard, up 5%. But still a very strong recovery. I think part of that is on the infection rates rolling over, part is on the easing of lockdown, part is on tentatively better medical news. But the big factor, of course, on the right is the explosion in the central bank balance sheets, and of course, all that stimulus flowing into markets. So it is a somewhat fragile recovery. One big new player is in the market there, and I think this will continue to underpin the central bank support. The Bank of Japan came out at the end of the week to say that they were so frustrated by their inability to restore inflation or a stable inflation rate in Japan. Note on that chart on the slide that the Japanese core inflation rate has met their target just 3 times in 25 years, that they will now purchase an unlimited amount of JGBs, and they will even fund small and medium enterprises through bank loans at a negative rate. In other words, they'll pay banks to loan. So this is yet another central bank showing the scale and magnitude of the action. Just one other small point before I wrap up. As you know, at Sarasin, we have substantial gold holdings for clients, and I just thought I'd reflect on these in one slide. That red line there on slide 10 is the gold price rallying sharply. What I'm particularly pleased about is it tends to rally when equity volatility, that's the VIX, the blue line, goes up. So it's a smoother for us. It tends to offset the sharp peaks and troughs. Now, it's not a one-way bet. On the right from the World Gold Council Q1 data, you can see Q1 19, that small purple bar was the very small ETF and financial buying. That's now exploded as people use this as a hedge. But on the other side, the green bar has shrunk, which is jewelry demand, which has fallen very sharply, particularly in India. So it's not a one-way bet, but it's a useful balancing tool for us. So in summary, we remain cautious. We've added a little bit of credit into our bond holdings. Our equities have drifted up from underweight to neutral as the price moves have lifted them, but we're still relatively cautious. Strong position in overweights. There's our gold, renewables and infrastructure, and a precautionary cash position. I hope that's helpful. Thank you.